What if the biggest difference between you and the top 0.1% isn't income, but how you think about money? The first way the top 0.1% invest differently is that they focus on ownership, not just income. Most people chase salaries, but wealthy investors chase equity. They don't just work for companies, they own pieces of them. Whether it's stocks, private businesses, or startups, they prioritize assets that grow without their daily effort. For example, instead of saving cash in a low interest account, they might buy shares in companies that compound value over decades. Think of someone who bought early shares in a growing tech company and held them through volatility. That patience transforms a modest capital into serious wealth. The key lesson here is shifting from trading time for money to letting money work for you. Ownership creates leverage, and leverage is what separates ordinary investing from elite wealth building. The second principle is long term thinking. The top 0.1% doesn't observe over daily market movements, they think in decades. While many panic during downturns, they see those moments as opportunities. For example, when markets dip, average investors often sell out of fear, locking in losses. In contrast, elite investors increase their positions in strong assets as a discounted price. They understand that volatility is temporary but growth is persistent. This mindset allows them to ride out short term noise and capture long term gains. Imagine planting a tree, you don't dig up every week to check its root. The wealthy treat investments the same way. Patience isn't passive, it's strategic. Over time, compounding turns even moderate returns into exponential growth, but only for those who stay invested. The third reason is diversification with intention. While most people diversify randomly, the top 0.1% builds portfolios like architects. They spread investments across asset classes, stocks, real estate, private equity, and sometimes even alternative assets. But every choice serves a purpose. For example, real estate might provide stable cash flow, while equities deliver growth and bonds offer stability during downturns. This balance protects their wealth from market shocks. But it's not about owning everything, it's about owning the right mix. They constantly evaluate how each asset behaves under different economic conditions. This level of strategic diversification ensures they don't just grow wealth but also preserve it. The result is a portfolio that performs consistently across cycles instead of relying on luck. The fourth factor is access to exclusive opportunities. The top 0.1% often invests in deals that aren't available to the general public. This includes private companies, venture capital, and early stage investments. For instance, investing in a startup before it goes public can generate massive returns if the company succeeds. While not every deal works out, the few winners can outweigh multiple losses. This approach requires strong networks and a willingness to take a calculated risks. It also means doing deep research and understanding industries before committing capital. Unlike real investors who react to headlines, elite investors often get in early before hype drives prices up. Access creates advantage and advantage compounds over time. The fifth reason is risk management, not risk avoidance. The top 0.1% doesn't fear risk, they understand it. Instead of avoiding investments altogether, they calculate downside and structure their portfolios to survive worst case scenarios. For example, They may allocate only a small portion of their wealth to high risk ventures while keeping the majority in stable assets. This may even if a risky investment fails, it doesn't destroy their financial foundation. They also use tools like hedging and asset allocation to protect their downside. This mindset allows them to take bold moves without jeopardizing everything. Risk, when managed properly, becomes a tool rather than a threat. The sixth principle is reinvesting profits. Instead of spending gains immediately, the top 0.1% reinvests consistently. When their investments generate returns, those returns are put back into new opportunities or used to expand existing ones. For example, rental income from real estate might be used to purchase another property. Dividends from stocks might be reinvested into more shares. This creates a cycle of continuous growth over time. These investments accelerates wealth accumulation through compounding. It's not about making one big win. It's about stacking wins over time. This disciplined approach ensures their wealth keep expanding instead of stagnating. The seventh reason is leveraging other people's money and expertise. The top 0.1% rarely builds wealth alone. They collaborate with experts, fund managers, and advisors who bring specialized knowledge. They also use leverage strategically, such as taking loans to invest in assets that generate higher returns than the cost of borrowing. For example, using a mortgage to buy a rental property allows them to control a large asset with relatively small capital. At the same time, they rely on professionals to manage risks and identify opportunities. This combination of leverage and expertise amplifies their results. It's not just about working harder, it's about working smarter with the right people and resources. The eighth factor is emotional discipline. One of the biggest differences between average investors and top 0.1% is emotional control. Markets are driven by fear and greed, and most people react impulsively. The wealthy, however, follow structured strategies that avoid emotional decisions. For example, they don't chase hype during bull markets or panic during crashes. Instead, they stick to their investment thesis. This discipline helps them avoid costly mistakes like buying high and selling low. Emotional stability is often underestimated, but it plays a huge role in long term success. The ability to stay calm when others are panicking creates opportunities that only disciplined investors can capture. The ninth reason is continuous learning. The top 0.1% treats investing as a skill that evolves over time. They constantly study markets, industries, and economic trends. They read reports, analyze data, and learn from both successes and failures. For instance, they might adjust their strategies based on changes in technology or global economics. This commitment to learning keeps them ahead of the curve. They don't rely on outdated methods, they adapt. This mindset ensures they remain competitive in a constantly changing environment. Knowledge becomes a powerful asset that enhances every investment decision they make. If you liked my video, please do consider subscribe my channel and please revisit the channel. I will see you in the next video. Thank you.